The failure of some smaller regional banks recently has sent the financial world reeling. Even though the government is promising to back up deposits, that's not really stopping people with savings in commercial banks and retirement accounts from asking, is my money safe? So I'm sure you guys have fielded this question a couple times recently. What is your answer to that?
That's a good question. And yeah, we have been getting it quite a bit lately, just all of the confusion and volatility in the markets has got a lot of people anxious. So I thought it would be helpful to go through a little bit about FDIC insurance and talk about what is actually insured when it comes to FDIC. So the money that exceeds the FDIC insurance limit, which is currently $250,000 per depositor, may not be as safe, obviously, as money that is. And it's important to know that $250,000 of insurance depends on the titling of the account. So individual, my understanding is a joint account. Also, trust accounts would have a $250,000 limit. So that's important to know. But if you are one of the depositors and you have more than $250,000 in a single account, or even across multiple accounts at the same bank. So that's important to know that if you have a single titling account, or you have multiple savings that have that same titling, they qualify under the same $250,000 limit. But if you do have money outside of that limit, it's at risk in the sense that you could potentially lose some or all of it if the bank fails. So to kind of minimize that risk, I think it's important that you consider maybe splitting up some money across multiple FDIC insured banks. And so we've talked about it ad nauseum in the last few segments, but Charles Schwab is a bank. I guess we should say we're a financial brokerage firm first. We happen to own a bank, but we do have FDIC insured bank accounts. And so it's important if you have deposits in brokerage firms and banks, it's important to know what the rules are for those as well. There's different insurance programs, SIPC, or the Securities Investor Protection Corp. But it's important to kind of address and just to take a look at where you're at. You can also, again, look at investing in other options instead of FDIC-insured bank accounts. So a lot of people don't know this, but insurance companies have fixed accounts. We call them annuities. They are generally backed by the claims paying ability of the insurance company. And so you've got a way there that you can invest, you can diversify outside of the traditional options like FDIC insurance into banks or out of banks and into brokerage firms in some cases with stocks and bonds and other investments as well as insurance through annuities.
So, Chaz, let me jump in for a second and ask you a question on this because, quite frankly, I didn't know exactly. You hear the news and you see these, all of these, scares and everybody's freaking out because all their money's gone, right? So, if it's titled in a different name, so like if I were to have an account in Scott Kirshner's account, blah 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 blah, and then what if I were to title monies in a different name? That I would own that. Are you saying that I would be insured up to $250 for each of those accounts?
Generally, it's the account title. It's not necessarily the name, but who is the owner? Is it an individual account or is it a trust?
Okay.
Yeah, so the titling is important. And but those are all good questions. And being a banker, this has kind of been a banker by trade. I was a banker for almost 15 years.
Yeah, I was too.
Yeah, so... and I was in, banking right in the 2008-2009 crisis, and so it is kind of a sensitive subject again to be talking about bank failures. Kind of thought we were past that, and it seems like, it's cropping up again. Although this is somewhat different, it has a little bit of a different feel than what we were feeling in 2008 and 9. There was a widespread crisis going on. I don't think that we're seeing that right now. We're kind of seeing it contained in some more aggressive banks. For instance, the Silicon Valley Bank dealt a lot with, I believe it was companies out in the tech Silicon Valley, so they're more, more aggressive by nature. But there are some correlations. We're seeing some of the similarities in the fact that there's just a lot of lip service. There's a lot of, we're fine. Our tier 1 capital ratios are fine, and we keep seeing more headlines of that there's some deterioration in the banking sector. So one of the things I would just say is that I feel like the government has been very good at identifying some of these issues and being very open to saying, you're going to be fine. So,
one thing I'll tell you, prior to 2008, I worked in a bank. I worked in the old Toledo Trust, downtown Toledo, back in, my first real job, so to speak, was in 1980 at Toledo Trust, downtown Toledo, right? And for as long as I could, and I was in operations, so I wasn't part of the tellers and the branch administrations, things like that. I processed everything at night when everybody would go home and sleep comfortably at night. I'm there busting my butt, making sure all of the deposits are made and put into the accounts, right? So if you don't understand how the banking works, it's really shocking, because prior to 2008, I'm thinking, how in the world can a bank fail? I mean, if the bank's got money. If the banks are failing, we're in a world of hurt. But I don't think a lot of people truly understand exactly how a bank operates, right? They bring in their deposits, but Chaz, isn't it true that a bank will actually invest some of their deposits into other accounts, just like you and I or Troy would be investing in accounts? Isn't that part of what banking does as well?
Yeah, I think just structurally, the banking system doesn't work. From, in my perspective, the major issue is the interest rate, the inverted yield curve. So to your point, banks primarily lend money.
Right.
And they pay out money in the form of interest. And so if they're able to lend, if they're lending at rates less than what they're supposed to pay at, the system doesn't work.
Right.
And so that's part of the issue, is that the Fed has raised interest rates so quickly and so aggressively that they're forced to pay out pretty much higher than what they're be able to take in loans. And the other fact is that banks are required by law to keep a certain amount of assets and reserves to basically back those depositors' deposits. And so that requirement is set by the government, and a lot of banks, instead of owning physical cash, will own treasuries and securities and debt of the United States government. Just as safe, just as good. So the issue with bonds, as we've talked about in previous sessions, is as interest rates rise, the bond portfolio that these banks have is no longer worth as much. They lose a lot of that asset and that reserve when the interest rates move up, because if they bought bonds that are paying 2% and 3%, now interest rates on the open market are 5%. It's just not worth as much.
Exactly.
And so that's kind of what we're seeing. Just fundamentally, the banking industry in general is under a lot of pressure because of their line of business that they're in. They lend, and a lot of the deposits they keep for emergencies are underwater.
Yeah. So there you have it. Don't freak out, but keep an eye on some of your investments, especially if you're in a smaller bank.
Yeah, and I think just from looking back at 2008, 2009, the government's, their policies like the TARP, Economic Stability Act from 2008, a lot of these initiatives were very successful. So ultimately, I think our listeners can take comfort in the fact that while sometimes these crises seem very significant and, we're leading, down towards like a full-blown recession, oftentimes the federal government's response has been very, very positive in stabilizing the financial system.
As we said many times here on the show, it helps to have that emotional detachment. And the news as of late, especially when it comes to banks in general and some of their underperformances or outright failures, could cause you concern. But don't go and take all your money, out of the bank right now and then go put it in a coffee can and bury it in your backyard. That's going to be counterintuitive to what you want to do. If you need help with that emotional detachment, whether it is with market performance, whether it is with banking, whether it is with inflation, anything as it pertains to your financial future and retirement, give a call to the team at America's Retirement Headquarters. Start developing that plan if you don't have one already to fall back on, and say, you know what, we've accounted for this, or get that reassurance that things will be okay. 419-794-3030. And to play devil's advocate here, if things do need to change, if things aren't okay, they will certainly let you know that too, but you'll be able to go about it in the most tactical and emotionally detached way possible. 419-794-3030, or you can go to the website, arhq.com.